Greetings, members one and all of the Salivation Nation. Are we at the start of a new gold-silver cycle? That's the topic of this video, and it's part of a new series by Visual Capitalist. They've done a new infographic here, long overdue really for silver. But keep in mind, some of these infographics, you have to sort of take them for a grain of salt, just like with any source of information that shows statistics. I'm a little bit cautious in some ways of some of these things, tend to take a sort of a balanced approach, and you have to consider the source and where this comes from. This does come from a silver miner company, so keep that in perspective here as we explore what this exactly means. And I do believe that there is some validity to a lot of the information in here. So let's explore this. The start of a new gold-silver cycle. The signs are pointing towards the beginning of a new cycle for increased gold and silver prices. There are several signals investors can use to spot the beginning of a new gold-silver cycle. Bankers are blowing bubbles. From 2008 onward, central bankers around the world launched a historic market intervention through quantitative easing, increasing the supply of money and lowering interest rates. And we're starting to see that here in the United States, with even Donald Trump saying that the interest rate should go to 0 or lower. With cheap and abundant money, QE worked. It worked so well that it created a bull market in everything except for precious metals. And that's just it. So some people call it, the fake bubble. And that bubble, the tighter that bubble gets, the more likely the chances that that bubble could burst. And walls become weaker. They can only do this so long. And most of us thought that it would happen a while ago, but it has been pretty resilient. A lot of that money is still out there. If you take a look at the S&P 500 versus the Federal Reserve balance sheet, you can see here how they are sort of inverting with each other. Here's the Fed balance sheet. Here's the S&P 500, and it's coming back down a bit. Both are decreasing, crossing each other there through this year. As a result, the stock markets, consumer lending, and property values had surged. And next is the debt. One result of cheap money are new highs of global debt. This is a fascinating chart looking at to see where the total global debt is. Almost $250 trillion now, based off of financial corporations, government, non-financial corporations, and households. And you look here and you can see how the most responsible group of all of these are you and me. Our debt is going up under households for sure, but it's not going up as exponentially as non-financial corporations and governments are. Financial corporations are climbing as well, especially since 1999. But look at this increase. It's pretty amazing to see. And really, since about 2016, it's been going up pretty steadily here. The massive increase in the supply of money erodes everyone's purchasing power, while ballooning debt creates systemic risks. And as J.P. Morgan once said, gold and silver are money, everything else is credit. So then we have currency versus precious metals. As more and more dollars chase a limited supply of goods, it is only a matter of time before the price of goods go up or inflate. This inflation erodes the purchasing power of every dollar, essentially devaluing currencies. And as we saw from history, many currencies have come and gone. All major currencies have depreciated relative to gold. So here we see the constant of gold and the draping of these other currencies over history. The mark basically disappeared in 1925 as it was. And the pound sterling has gone down quite considerably. Look at the yen. And the Reichsmark, 1945, obviously the fall of Hitler there. The Deutsche Mark, fell. The European Central Union, we had the euro, and the US dollar, look at that, has fallen dramatically. All these currencies. Silver is the poor man's gold and closely follows the performance of gold. Well, it has, although in the last couple of years, the ratio has widened quite a bit. We'll talk about that more in a moment. But amazing to see these currencies and how they drape down past gold, way down, and gold pretty much stays constant. And relative to gold, these currencies have fallen dramatically. Gold and silver preserves their values over time relative to currencies, yet the current prices of gold and silver do not reflect the reality of cheap and abundant money. It's only a matter of time for gold and silver to shine, but when? And that's just it. That is the power of fiat currencies, and that's why I'm not so bullish on saying that, hey, gold and silver is going to go to $10,100 an ounce or what have you. Because we could go on for quite a while. And the fact that the dollar is really one of the best performing currencies as a reserve currency around the world, because it is on top, there's probably a lot more cushion for it to go before we see it fall as such. The perfect storm for gold-silver cycle. Investors can use several indicators to gauge the beginning of this gold-silver cycle that we talk about. Futures contracts. Most traders do not trade physical gold or silver, but paper contracts written with the promise to buy at a future price. So every week, U.S. commodity exchanges such as the COMEX and NYMEX publish the Commitment of Traders Report, the COT. This report summarizes the positions, long or short, of traders in a particular commodity such as gold or silver. There are three basic groups the COT report tracks: the commercial traders, or hedgers, the long commercial traders, or large speculators, and the retail traders, which are small speculators. Then you have the number of positions, short or long. It's very interesting to see how this is laid out here. And I don't fully, grasping all this and trading in the paper market, some of you that do that in the electronic markets probably much more familiar with this process here. So here we see a squeeze when they're all kind of conflate together here. For the first time since 2016, speculators went short and commercial went long, potentially signaling the start of a new cycle. And this is sort of out of my range of understanding completely, but typically speculators are long and commercials are short. But that changed in 2016, which led to a huge gold price rally into 2017. The same pattern occurred in September 2018, and we see there. So there we go. Widened up pretty big here. So the gold to silver ratio compression. The gold to silver ratio is the amount of silver it takes to buy 1 ounce of gold. A ratio of 50 means you could use 50 ounces of silver to buy 1 ounce of gold. And here we see it throughout history here. When the gold to silver ratio compresses, the price of gold and silver can move dramatically. For example, silver went from $1.89 in November 1972 to $36.13 of February 1980, an increase of 1,811%, while the gold to silver ratio was in a downtrend. And here we see there. And there is where plus 60 gold 8%, and where it is throughout there. 50-year average of gold to silver ratio. It's quite a fascinating chart here. You can see up here it's back up again, especially since 2013. They've really widened up big time. But you can see here in 1991 was right around 100. These are the increases there. Very interesting indeed. Falling ratio is depicted here in these gray areas. As the difference between gold and silver prices fall, the compression of the ratio, history suggests silver prices can make big moves upwards in price. That's what history shows, but history is not always an indicator of future performance, especially considering where how silver is used as a commodity. But this talks about here the scarcity, the declining silver production. Now, the total global silver supply decreased from 1,050 million ounces in 2014 to approximately 950 million ounces in 2019. That's estimated. Now, comes from Thomson Reuters Silver Institute, and you have to ask yourself the question, why? Despite its growing importance as a safe haven hedge, that's where I disagree, and use in industrial applications and renewable technologies, silver production has been declining. It has its importance as a safe haven hedge, I don't think has been there as much. That's why you've seen less demand for those who have been accumulating the physical as a hedge, or even in the paper markets and electronic markets. Now, it has increased demand in industrial applications and renewable technologies, but that does not necessarily translate to jewelry or to using silver as a hedge. The silver exception, number 4, is not just precious, but useful. Silver is not just coins, bars, jewelries, and the family of silverware. It stands out from gold in a variety of practical industrial uses that account for 56.1% of its annual consumption. In that way, it sort of is opposite of kind of what was saying here. Because obviously it's less than half or demanded for the other things. But this is quite fascinating here. The total global silver demand in 2018 is 1,033.5 million ounces. Out of that, it is fascinating to see the demand in electronics is 24%, 7.7 photovoltaic. I'm surprised it's not a little bit more than that. Alloys and solders, photography, very low. I thought it would be actually less than that. Ethylene oxide is 1%. That's interesting. Other industrial applications are 14%. And then here, look at this. 20.5% in jewelry. That's a big chunk, huge chunk here. That's second to electronics. Silverware is 5.9%. I'm surprised that's that high, but look at this. 17.5% is it for coins and bars. If we see this grow, I think we're going to see the price of silver go up. People have got to buy it. That's the thing. People aren't buying it. I think that's part of the reason why in electronics, that's why you see this as used as a commodity. And really, in some sense, you can see silverware as a commodity that's being used in silverware. That's probably mostly plated at this point. But a vast chunk here. Jewelry, you can almost take half of that as a commodity. That leaves very little for the demand side and as a hedge, or what some people call an investment side. I don't like to use that term. Silver demand will continue to grow due to its role in renewable energy, notably as a key component in solar photovoltaic cells. The total global renewable capacity here in 2017 was at 54.5%. Other renewable capacity and solar, and they project by 2023 1 TW, 17 GW, 57% as a close of 54. Very interesting indeed. All right, here's the price of gold and silver, 19 and 1550. We could see the widening ratio here and the growth in here, and how we can see how they kind of come together, are merging back a little bit. But this chart is kind of strange how it's just showing in US dollars, why they have it kind of conflated here, 1550, where they're showing a big wide here and coming in here. Very interesting. The prices of gold and silver do not reflect a world with cheap and easy money, but their time to shine is here. So an interesting infographic, I believe, from this particular company, Endeavor Silver. They find, build, and operate quality silver mines in a sustainable way to create real value for stakeholders. But nonetheless, they don't really make the case that silver is going to shine, but I do believe that probably in the end, considering the debt and everything like that, there's a lot of reasons to say that gold and silver both will shine, but not necessarily does that mean that the ratio will tighten up to where we think it should be. This is a part of a 3-part series. I'll kind of keep up and see if when the second part comes out and do a video on that, but found this quite fascinating. What are your thoughts? You think this makes the case for the start of a new gold-silver cycle? Cycle being defined as being more purchases or higher silver and gold prices. And that is going to be the telling thing to see how that is reflected. I think this chart here on the silver uses and the lack thereof for the bullion part category, I'd love to see how this chart played out over the last 10 years. Well, can we see this number increase? We shall see. Post your thoughts below. I'd like to extend a multitude of gratitude y'all for watching and encourage you to please rate, share, comment, and subscribe.